Imagine that from this price data, the Nasdaq 100, we could generate four signals derived from the RSI 1 and 2 that show a high-frequency noisy behavior, and RSI 3 and 4 that show a low-frequency smooth behavior. Now, these four RSI signals can be used in an algorithmic trading framework. Basically, what do? We start with the asset price. We perform some signal processing where a user can also adjust some input parameters, and then the output of that is used for algorithmic trading. In this video, we will illustrate two methods that helped us derive these four RSI signals. The first one is a single RSI indicator processor, where we can adjust the time period, so we can change it from the classical 14 period to something else. And the second approach will be to first apply a filter, a frequency domain Butterworth filter to the asset price, where we can adjust the cutoff period. Then the output of that is the input to the RSI indicator, where we can also adjust the time period, and then the output of that is used for algorithmic trading. Quick disclaimers: we do not give investment or financial advice. We are only sharing our personal opinions. Now, coming back to our four signals, remember we had RSI 1, RSI 2, which is a little bit more noisy, a little bit more high frequency, RSI 3, and RSI 4, which both are low frequency and smooth signals. And my question to you, based on those four RSI indicators, can you do the mapping? Can you find out which one is what? So there is one is an RSI 5, just a plain RSI 5. Another one is the standard RSI 14. And two other ones, they first apply a Butterworth filter with a time cutoff period of 100, and then they apply the RSI 5 or the RSI 14. So here are the answer now. You probably would have guessed. The top left one is the standard RSI 14. This one on the bottom left is the RSI 5. The top right one is the one that applies the Butterworth 100 plus RSI 14. And the bottom right is the Butterworth 100 plus RSI 5. Now, in the sequel, in the rest of the video, we will focus on this signal here, applying first the Butterworth 100 and the RSI 5, and we will show how we can use this one within a algorithmic trading framework. As illustration, we show here the three main steps of such an algorithmic trading framework. In this case, we will only have long-only positions. So there are three steps: the pre-processing one, the basic setting of the algorithm, and additional constraints. And then we identify the entry position, the long entry, and the long exit. So what do? We first start by pre-filtering the price data. So here we apply a frequency domain Butterworth filter with a cutoff period of 100 days. Now, this filtered signal is subsequently used in the entry logic of the algorithm. So in this case, what do? We will use this filtered signal and then apply an RSI to it with a period of 5 days. We will check whether the RSI is below 30, and then we will check for an uptick in RSI. So we'll try to see whether the RSI of the current day is higher than the RSI of the previous day. This is the entry side. And then we will only validate such an entry in case the unfiltered price is above its SMA of 200 days. So if we have that, then we have a valid entry. For the exit of the algorithm, so basically closing the long position, it's very simple in this case. As soon as the unfiltered price drops below the 200 days SMA, then we close the trade. Notice that here we have not done any optimization or fine-tuning of the algorithm. As you can see, the SMA, we use standard 200 days, in this case here, and in the constraint here. For the cutoff period, we use 100 day. And then for the RSI, we use quite a standard threshold of 30. Just here we have used the 5 days instead of the 14 days. But aside from that, there is no much of a fine-tuning or optimization. So this is really a simple basic setting to illustrate the concept. Now going back to our quantitative investing dashboard, the page that will help us now illustrate our algorithmic trading will be the RSI optimization one using the Butterworth filter. It's a page that shows the price on top and the relative strength index or RSI in the bottom. The difference with the previous page, the RSI with the Butterworth filter, so the previous page was the topic of our previous video, is that in the previous page we cannot adjust the RSI time period. It's set by default to the classical standard 14 value. In this page, you can actually select and take anything you want between, I think, 1 and up to like 250. So there are really lots of combinations to try. And next to that, on this page, you can add this pre-filtering using the Butterworth filter. In this case, it's set to 100 time period. And then you can also superimpose an SMA. So if you click here on the legend on the green line, then it's going to show the filtered signal using the Butterworth filter. In white, it's going to superimpose the 200-day simple moving average. And in the bottom RSI graph, if you click here on the legend, the green one, it will show the RSI using the 5-day time period. And this RSI is applied to the green line that you see here on top. And that's the filtered price using the cutoff period of 100 days. So both of these graphs are very interesting to analyze later on when we will further do a deep dive on the algorithm. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, in summary, how to combine the 3 steps of this algorithmic trading with the visuals of our quantitative investing dashboard. We have step number 1, the pre-processing, where we will filter the price data using the Butterworth frequency domain filter using a 100-day time period, cutoff time period. And so you see here both of the signals, the unfiltered in blue and the filtered in green, and you will recognize those from the dashboard. This is only used in the entry logic of the algorithm. Next, we have the basic settings of the algorithm, where basically we will use an RSI with a 5-day time period. We will check whether the RSI is below 30. We will look for an uptick in RSI, and you see here these are the green are the RSI. And then once the RSI starts to increase, and if it's below 30, so this could qualify as a long entry, this one as well, this one as well. And then we will look at the exit of the algorithm. So what's the logic? As soon as the unfiltered price drops below the 200-day simple moving average, so here this would qualify as an exit of the algorithm. And then finally, we add the constraint. So we will say the entry will only be valid if the unfiltered price is above its 200-day SMA. So all of this range here is basically an area where the entry would be valid. And again, you can adjust all of those input parameters through the control panel of the dashboard. Now we will use our dashboard to illustrate this algorithm. First, we will unclutter the graph, so we'll remove what we do not need to see, and then we click here on the legends to remove the signals. And let's have a look at the entry points. So where would be the first entry point? We see here that the RSI is below 30. It's close to 0. There is an uptick in RSI around, let's say, the 29th of August 2022. That brings us about here, and we can see that the price, the unfiltered price, is below its 200-day SMA. So this does not qualify as an entry point. Next one would be this one, around 24 January. Let's zoom in. There is an uptick on the 24th of January 2023. We'll then zoom in around this area. 25, 20, 23, 24th of January, we are again below the white line, so below the 200-day SMA. So this one again does not qualify as an entry point. Next one would be here. And it brings us to the 13th of December 2023. 13th of December. So we're gonna be somewhere here, and that's way above the SMA. So this qualifies as an entry point. And the value of the Nasdaq. Okay, let's zoom in. The value of the Nasdaq was around 16,500 points. Now, that would be the entry point, and then since we're already having a long position, so we do not need to consider the other entry points, and then we will close the trade when the price drops below the SMA. So that happened here on the 6th of March 2025, and the Nasdaq is about 20,000 points. So we see that this would have been a long trade, and quite a winning long trade, because in about 15 months we would have made approximately 22-23% return on the position. Now, as a reminder, this is our simple algorithm that we just illustrated using the dashboard with the 3 steps, and the pre-processing, the basic setting, and the constraints. Now, suppose we were to apply this algorithm to the Nasdaq, but on a much longer time period, so spanning from January 98 until May 2025. What would we see? Well, this chart shows you exactly that. On the x-axis, we have time in years. On the y-axis, we have the results of each trade. And in green, you would show the winning trades in percentage of entry position, and in red, the lost trades. And the trade that we just examined using the dashboard is actually the last one that we closed in March 2025 with approximately 22-23% return on the position entry. So this algorithm basically delivers 23 trades in total, of which 9 are winning and 14 are losing trades, so a win ratio of 39%. And what we see is that the winning trades tend to be quite large. We even had one with approximately 100% winning position, quite a few above 40%, and then 2, 3 around 20% winning positions. And the lost trades, they are more, we see more of them, but they are quite small. So if we look at this second chart, what we see here again on the x-axis is time. On the left y-axis, we see the Nasdaq daily price in black. So it is this line here in black. That's the left y-axis. On the right axis, we see the absolute return of this algorithm. So how many Nasdaq points do we make on each of the trade that happened? And what is interesting to see here is, for instance, that the worst trade loss was about 5.5% of entry position, that we have a huge profit factor with this algo trading, about 12.3, and the median holding period, so on average, how long do we hold a trade? In this case, is about 5 months. And remember, the one that we illustrated in that we closed in 2025 was about 15 months, so longer. But on average, it would be about half a year. So these are interesting results for such a simple yet robust algorithm. Coming back to this chart, The good things about this algorithm is that it has a high profit factor and it also has a low maximum trade loss of 5.5%, especially compared to the gains that it shows, really large profit gains. So that's the first good thing. The drawback about this algorithm is that the number of trades are few and far between. So this is really an algorithm for, let's say, long-term investors. So that's the first aspect, is that you can see there are periods where there are no trading activity, like here between 2008 and the mid of 2011, so 3.5 years. The second drawback is that it shows, for instance, in this period between 2004 and 2008, a maximum loss streak of 4, so meaning 4 consecutive losing trades. And so this can also be, strenuous from a psychological point of view. Now, in the beginning of the video, we had 4 signals that we potentially could consider for an algorithmic trading framework. And we eventually settled for a version of the signal that first performs a Butterworth filter and then applies the RSI with a period of 5. But the other 3 are also potential candidates for an algorithmic trading module. And we had 2 RSI signals without any filter, the standard RSI 14 and the RSI 5, or we could potentially also use the filtering plus the RSI 14. And so now my question to you is, what would you think the performance of such a trading module would be if we were to also test the other 3 signals? So we know when we applied the filter plus RSI 5, we had a profit factor of 12.3. But what about the other 3 options? And so we have done this while keeping all input parameters constant and equal to the case we just illustrated previously. And so what do we see? We see that when we apply the RSI 14, we get a profit factor of 3.2, so a much lower than what we had with the filtering. And when we apply the filtering, it actually it bumps up the profit factor to 7.4. So in this case, with the RSI 14, applying the filtering is actually beneficial. But for the RSI 5, we see the reverse. We see that a plain RSI 5 has a profit factor of 13.2, and when we apply the filter, actually the profit factor decreases slightly, but it does still decrease. So what we can conclude from this is that there is no universal conclusion whether applying the filter is a good thing or a bad thing. It really all depends on the parameters of the remaining logic of the algorithm. So in this case of the time period of the RSI, but also the other parameters that were used in the algorithm. Now, let's do the following. Now we will focus on the RSI 5 without any filter. And we will now give you an example of how to actually improve this algorithm and do some optimization. So if we look back at the full logic of this algorithm, there is no pre-processing anymore. And this step is empty because we do not apply any filtering. For the basic setting of the algorithm, what are we going to do? We keep the RSI at 5 days. We keep the same logic that when there is an uptick in RSI, then it's an entry point. But we will now optimize this RSI threshold of 30. We will try to see whether other values can deliver a higher performance of the algorithm. For the rest, for the SMA part, whether in the constraint for the long entry or whether for the exit, we'll keep it as it was. So we'll keep it to 200 days. And if we do this, let's have a look at now how to optimize the RSI threshold. And so we will do a search loop between values ranging from 14 until 30. So this is called In sample optimization, we will look at a time frame between January 1998 and December 2010, so 13 years. And then we will show you here on the right the performance of this algorithm. So the number of winning trades, number of losing trades, the win ratio, the max loss streak, which is the amount of consecutive losing trades, the worst trade loss in percentage, the profit factor, and the holding period of the combined trade. So how long are we in the market? And what do we see? We see that actually, if you were to choose an RSI threshold below 20, this delivers the higher profit factor, 10.3. But this is not necessarily the most robust value, because we see that one step away, it already drops at 7.2 with a threshold of 18. And one step further at 22, it's still high. So we are better off choosing actually this value here of 9.2 or 9.9 perhaps, but anyway, within this range, so within, let's say, 22, 23, it's a much better robust value than using the one that delivers the highest profit factor. So we'll settle for a threshold of 22 in this case. This gives us a profit factor of 9.2. The worst trade is 6.4%. Max loss streak is 2, and a win ratio of 57. We will evaluate now this algorithm with the selected value of 22 as a RSI threshold in a so-called walk-forward test. So this is also known as out-of-sample validation. And if you look at here, the row that shows RSI threshold of 22 delivers actually the worst trade loss of 4.6% and a profit factor above 24 with a win ratio of 55%. And this is done in the period January 2011 until May 2025. So really encouraging and really positive results from the validation test. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Now, if we use this RSI threshold of 22 and apply it now on the full data sample that we have, so from January 98 until May 2025, and we look at this row with the RSI threshold of 22, then we have a total of 18 trades, 11 winning, so we have a win ratio of 61%. We have 2 consecutive losses as a max loss streak. The worst trade loss is 6.4%, and we have a profit factor above 23. So really, also again, very nice performance from the algorithm, from a very, very simple algorithm. Summarizing, this is the logic of the algorithm. So no pre-processing step, a simple basic setting and simple constraints. In the basic setting, we're using now the RSI threshold of 22. And if we look at the performance, so this is what we get for the NASDAQ 100 between 98 and 2025. So we have 18 trades. You see them, the green are the winning trades, the red are the losing trades. 11 winning, 7 losing trades. The worst loss is 6.4%. We have a huge profit factor now, above 23. So it went from 12 to 23 when we optimized the RSI threshold. And you see the winning trades tend to be quite large. Quite a few of them, 6 are above 20% or 25% gain on entry position. So on the look of it, it really it looks like a really nice algorithm with great performance. Coming back to our dashboard, in the next video we will explore the Bollinger Bands indicator using a Butterworth filter. Thank you for watching, and until next time.